Hello again, everyone. Today we're going to be walking through the activities in Chapter 9 with Mookie the Beagle Concierge. In this chapter, we're going to shift our focus to adjusting entries, those important updates made at the end of an accounting period to ensure that the financial statements reflect the correct balances. You're going to see how adjustments fit into the larger accounting cycle, and we'll practice making them directly in QBO. Along the way, we'll take a look at the different types of adjustments like prepaid items, unearned revenue, accrued expenses, and accrued revenues, and then we'll bring it all together with an adjusted trial balance. Think of this chapter as the steps that get the books fully caught up before financial statements are prepared. By the end, you'll have a clear picture of why adjusting entries matter and how to record them properly inside of QBO. So I'm going to start off here taking a brief look at a section in our textbook. Section 9.2 talks about the accounting cycle. And the accounting cycle is a series of accounting activities that a business performs recurringly each accounting period. An accounting period can be 1 month, 1 quarter, or 1 year. If we're talking about large publicly traded companies, at a minimum, they're going to need to do the adjusting process and walk through the accounting cycle at least quarterly because they have quarterly reporting requirements. For many small businesses, it might not happen as often. It might be every 1 year. The best practice is probably to do them monthly so that you get more timely information about the financial health of the company. But of course, it costs money to go through this process of making adjusting entries. You have accounting work to do, so you'd have to pay employees to do that. So in practice, it might not always happen monthly, especially if we're talking about smaller businesses. Now, if you think back to your Principles of Accounting course and how they discuss the accounting cycle, this graph might look a little bit different here. It's listing the chart of accounts as part of the accounting cycle. Now, that's not usually a recurring portion of an accounting cycle, but setting up a chart of accounts is definitely an important step. With the setup of the chart of accounts, we design the names of all the different asset, liability, equity, revenue, and expense accounts that we use on our financial statements. We create the chart of accounts when the business is first established, and then we typically modify it as needed over time. Now we get into the recurring steps. So they listed out transactions. I would argue that this is really source document based transactions. And what do I mean by that? A source document is a source of information, and it might be a paper receipt or a paper bill that you received from a supplier, or it could be an invoice that you sent to your customer. It could be your bank statement. Those documents, whether they're physical in nature or electronic, are sources of information for the bookkeepers and accountants to record events, to record transactions that have taken place. So that's what we're talking about here, are the day-to-day transactions that come from source documents. And from those source documents, we prepare a trial balance. A trial balance is a listing of all of the accounts from the chart of accounts that had balances at the end of a period. We list out those balances in either the debit or credit column, depending on what side of the ledger the balance ended up on. If we take the total of all those debit balances and add them together, and the total of all the credit balances, add them together, the two totals are going to match. It's going to verify that the accounting system is in balance, that total debits equals total credits. Preparing the trial balance at this point in the accounting cycle, we often call this trial balance the unadjusted trial balance, and that means that the report was prepared before all the accounts were adjusted in the year-end adjusting process. I'll talk about that in just a second. The trial balance is a useful checkpoint because it shows whether the books are in balance, but it doesn't yet reflect things like expired insurance, used supplies, or earned revenue that hasn't been recorded. And that's why the next step is so important, making the adjusting entries so our trial balance becomes adjusted and our financial statements are accurate. Adjusting entries are a little different than the day-to-day source document transactions that we just talked about a moment ago. Those entries are tied to some kind of source document, and today that might be electronic instead of paper. An emailed invoice, an online receipt, a digital bill, those are all source documents. Adjusting entries are different because they're not triggered by any kind of document, paper or electronic. They're our way of recording things that really happened during the period but haven't been entered yet, like the use of supplies in the office. It's not like we're going to ask our employees to fill out paperwork every time they staple two pieces of paper together. Instead, what we do at the end of the period is we take a physical count of the supplies that remain in the supplies cupboard, and we compare that against the unadjusted balance of the supplies account from our trial balance. And maybe we can see, oh, the trial balance says that we had $1,000 worth of supplies. We counted them up and we only see 400. Therefore, the assumption is that we must have used $600 worth. 1,000 less 400 equals $600. So that we're going to need to make an adjusting entry to reflect the used supplies. That's what we're going to spend quite a bit of our time today in QBO doing, is some adjusting entries to get Mookie the Beagle Concierge's books up to date so that we can prepare our adjusted trial balance, which is just another trial balance showing all the account balances in either the debit or credit column, depending on where they landed in their ledgers. And the difference, though, is that now some of the accounts have changed in balance because of these adjusting entries. Not all of them, but many of them. And then finally, once that adjusted trial balance has been prepared, showing the equality of the total debit balances and the total credit balances, then the business can produce the financial statements. And we're going to be focusing on the income statement and the balance sheet. The income statement shows all the revenues and expenses during a period of time. The difference between the revenues and expenses is referred to as either the net income, if the revenues were larger, or the net loss if the expenses were larger. It shows how much profit or loss the business made during the period. Whereas the balance sheet shows the company's financial position. It shows the assets, all the different resources that the business owns. It shows the liabilities, all the debts of the business, and it shows the difference between the assets and liabilities, which is referred to as the owner's equity, which is the owner's claim against the business's assets. We'll be reviewing this accounting cycle as we work through Chapter 9, and now we're going to move over to the QBO company file for Mookie the Beagle Concierge. So I'm in my company. I'm going to mouse over reports. I'm going to pull up standard reports, and I'm going to run a trial balance report. So I'm just going to type the word trial in the search. There it is right there. And what I'm going to do here first is change the date range. So the book says to use January 1st through January 31st. And then we're going to click run the report. And here's our trial balance for Mookie the Beagle Concierge as of the end of January 2025. So what I'd like you to do is take a moment, maybe pause the video, and compare your balances on your unadjusted trial balance against these ones. And if you see any differences, then you might want to figure out why there are differences. And what I can do next is pull up the general ledger report, which is going to show the activity in each of these accounts, and you can compare your activity to mine and see if you can figure out why there are any differences. So to do that, I'm going to go to reports. I'm going to select custom reports because I've already saved this report with all of the dates. A lot of students will make date errors in this class, so that's why we saved this report earlier. If you didn't save it earlier, if you go to the top of the page on your general ledger report, just change this drop down to say all dates and hit run report. And what I'm looking for here is anything that's outside of January 2025 first. So I'm looking at all these dates of all these different events and scanning for any dates that are outside of January 2025. And if I see one that's outside of it, I can just click on that date. It'll pull up that transaction entry screen that we originally used to record the transaction, and then I can change the date. I probably want to go and look up the date in the book if I found one like that. After you've done that, what you can do is just sort of take a look at the account that you found that was different in balance from my check figure I showed you a moment ago. We see the account balances on this ledger report in bold, and if you see any differences, you got the activity right above here that resulted in this balance. So you'd want to compare what you see here against what's in your company file and see if you can determine why there is a difference. So I'm just going to spend a little bit of time here just sort of scrolling down. If you needed, you can pause the video if you find a difference and try to figure it out. Of course, you can always reach out to me if you want some more assistance. So there's all those balances and the activity that resulted in those balances. Now this is important to do because in order to prepare adjusting entries and have your check figures match up with mine, your unadjusted balances need to match up with mine. So if they don't, we're going to have trouble getting the adjusted balance correct. So we should first take care of any balances that have issues from the unadjusted balances. And once again, I'm going to pull up that trial balance report. So mousing over reports, going to standard reports. It'll be nice to have our own trial balance ready in case we need to review it as we work through the adjusting entries in Chapter 9. So I'm just going to pull that up again and get those dates to match January 1 through January 31st of 2025. All right, there it is again. And what I'm going to do is I'm just going to keep this report open on a tab, and I'm going to open up the QuickBooks on a separate tab and do the work, but I might come back and forth between this trial balance to review these balances before I make my adjustments. So what I'm going to do is I'm going to right click on the Intuit QuickBooks logo up here, and I'm going to open link a new tab, create a new tab, and it's going to get me to my home page of my QuickBooks company file. And now I can just sort of toggle back and forth between these as needed. And taking a closer look here at this unadjusted trial balance, you might remember that when the business was purchasing prepaid items like prepaid insurance and supplies, that the business had the practice of first charging those expenditures to expense accounts. So when we bought supplies at Office Store, we charged it directly to an expense account. Let's see, which one do we use? Office expenses for stuff like that. And at first that might not seem entirely intuitive, because if you just purchase supplies, well, you still have them. Don't they consider them an asset? Well, you're right. If we still have the supplies, they are something that we own. They are assets. The reason why it's okay for this business to originally charge those costs to an expense account is because of the adjusting process. At the end of the period, we're going to remove the unused portion of the supplies from this expense account and place it into the asset account. So at the end of the period, we still end up with an asset account that reflects the supplies that we still own, and we have an expense account that reflects the supplies that were used. So that's what we're going to be working through, is some adjusting entries. That's an example of one of them that we're going to do. The text has a section, it's section 9.6, I'm going to put it on screen here in a moment, that talks about the different types of adjusting entries. There's basically 4 categories, 4 buckets of adjusting entries. The first is our prepaid items. So we're talking about things like prepaid insurance or supplies. These are transactions where we paid for an asset up front and then we use that asset over time. Depreciation also falls into this category. So with that kind of transaction, we need to make sure that both the asset reflects what we still own, what we still have of that asset at the end of the period, and the expense represents what we used of that asset during the period. Our next category, they labeled as unearned items. I'd argue that it's unearned revenue that we're talking about here. So these are transactions where the customer paid the business in advance, and then the business performs a service or delivers goods later on. And what happens at the end of the period is we need to make sure that the revenue reflects what we earned related to that unearned item, and the liability account, because if the customer paid us in advance, we actually have a liability to them. We owe them the goods or services. That liability account at the end of the period reflects what we still owe to those customers who had prepaid. And then we have 2 more categories. Accrued expenses, those are expenses that are recorded before they are paid. And then accrued revenues are revenues that are earned but have not yet been recorded or collected. The text briefly mentions the concept of the accrual basis of accounting. The accrual basis of accounting records revenues when they've been earned and expenses when the asset or service has been used. When publicly traded companies produce financial statements, they are required to prepare those statements using the accrual basis of accounting. Another basis of accounting is referred to as the cash basis of accounting. A lot of small businesses use this. The cash basis of accounting records revenue when the cash is received from the customer and records expenses when the cash is paid out. The adjusting entries that we're going to do for Mookie the Beagle Concierge as well as Haffer Cyber reflect the accrual basis of accounting. And then one last thing, when we prepare adjusting entries, each one of them typically will involve either a revenue account or an expense account, as well as either an asset account or a liability account. It's a little pattern, so we'll have either a revenue or an expense, and either an asset or a liability. So it's a little pattern that we can look for when we prepare these adjustments. Sections 9.7, 9.8, 9.9, and 9.10 of our textbook talk about each of these 4 categories of adjusting entries in a little bit more detail. Make sure to read through those sections. Also, at the end of each of those sections, they do have steps in QBO related to adjusting entries, but they don't show how to calculate the amounts, and they actually don't have us saving those adjusting entries. So I'm just going to skip over that and get to the examples of where we actually prepared the adjusting entries which are at the end of the chapter. Another good section to read, though, before we get into those adjusting entries is section 9.12. It's labeled Accounting Essentials. It goes through and talks about adjusting entries in a little bit more detail, and it compares them against correcting entries. Correcting entries fix mistakes that have been entered into the accounting system, whereas adjusting entries are not mistakes but updates that are required to bring the balances of the accounts up to date for financial statement preparation purposes. The text talks about an example of a correcting entry, and then it also talks about how do we correct errors on saved documents, and it talks about deleting documents or voiding documents, and it gives the argument that deleting deletes the entire document and it erases it from our system, and that voiding is preferable typically because we got a better audit trail that others could look at seeing those changes. So a lot of companies will have a policy that we don't delete, that we void instead. And just to quickly demonstrate that, let's say that I was inside of my general ledger for Mookie the Beagle and I wanted to void one of these transactions, remove it from the system. So I'm just going to pick on any one of these. I'm not actually going to void it. All right, so I clicked on one of those transactions, pulled up the original entry screen that we used to record it. And the way that you would void or delete a transaction is by clicking on the More button, and you can see you got the 2 options of either void or delete. And generally speaking, void is preferred because there's a better audit history on that. So now I'm taking a look at Mookie exercises 9 and specifically looking at EM 9.1, and this is going to ask us to do an adjusting entry related to our prepaid insurance. And we can see here on this unadjusted trial balance report that if we look at the asset accounts, which are in the 1,000 range, we don't have a prepaid insurance asset. But if we look at the expense accounts, which are in the 5,000 range, we do have a related account here with 5,012 insurance expense. We see that it has a $600 balance. So the company at the end of the period would have to research this $600 expense and ask, hey, did we use all of that? Because expense accounts are supposed to represent the assets or services that were used by a business during a period of time. We're going to say, hey, did we use all $600 worth of this insurance by the end of January? So then we'd have to research, well, how many months did the $600 cover? And per the book, it covered 3 months. So since it covered 3 months, we need to figure out what the monthly amount was. So we take that $600 and we divide it by 3 months, and we can see that the insurance was $200 per month. We are preparing these adjusting entries as of the end of January. So as of January 31st, only 1 month worth of insurance has expired. So when we take a look at the balance in our insurance expense account currently, we can see that it's overstated. This is 3 months worth of insurance, but we've only used 1 month's worth. The balance of an expense account should always reflect the assets or service that were used by a business during that period of time. And in the case of insurance expense, it should reflect the insurance coverage that has been used this period. So too much is in the account, it's too high, it represents 3 months worth, we're only supposed to have 1 month's worth in there. The prepaid insurance account, on the other hand, which is an asset account, doesn't exist currently. Now, if you think about what assets are, by definition, they're resources the business owns. Well, we don't have a prepaid insurance asset here, but we should after adjusting is done. And the logic here is that the balance of the prepaid insurance account should reflect the insurance coverage that has not yet expired, that we still have. So we need to reflect that because we have not used all $600 worth of insurance. So to help us see this, I think it helps to make a T account for both the insurance expense as well as the prepaid insurance. All right, so I've created T accounts for both the insurance expense as well as the prepaid insurance. The prepaid insurance on our unadjusted trial balance isn't listed, so it has a balance of 0, whereas the insurance expense is $5,012. Expense has a $600 debit balance. So we just determined that the insurance expense account is too high. It should only reflect the insurance coverage that has been used this period. And we just said that 1 month's worth of insurance has been used and that was worth $200. So the balance of this account is overstated. It should be $200. So I'm going to reflect this in the T account now. So we want the insurance expense to have an adjusted balance of $200. So we can see, oh, it has a balance currently of $600. I want the balance to be $200. I need to subtract $400 from the account. And the way that you subtract is you place an entry on the credit side, on the right side there. So we can see that we're going to have to adjust the account for $400. That $400 is the amount of the adjusting entry. And over here on the asset side, the prepaid insurance right now has no balance at all. But the balance of this asset should reflect the insurance coverage that has not yet expired. Well, that's exactly what the $400 represents. So the account should have an adjusted balance of $400 after we're done with it. So to go from a balance of 0 to an adjusted balance of $400, we can see we have to add to the account. And this is an asset account, and to add to asset accounts, you place the amount on the debit side. So that's where our adjusting entry is going to do. It's going to debit our prepaid insurance. So that's our adjusting entry here. We have a debit to our prepaid insurance of $400 and a credit to our insurance expense of the same amount. That'll get the adjusted balance of the expense reflecting the used portion of the insurance payment and the asset representing the unused portion. So now we're going to do that in QBO. So I got this other tab with my home page there, and let's see, the navigational menu's hidden, so I had to expand it out by hitting this button. And let's see, we're going to find the create, and actually I'm not seeing it, so I'm going to maximize. There it is, a little bit better. There's create, and in the other category I'm going to select journal entry. Alright, so the first thing I'm going to do here is I'm going to get the date correct here. So we're preparing all these adjusting entries as of January 31st. And then I'm going to give the journal entry a number. I'm going to give it the prefix ADJ for adjusting entry, and then number 1. So now I'm going to reflect the journal entry that we just prepared in those T accounts. So we don't have to follow the convention of list the accounts that are debited first and the credits after, but I'm going to because that's how I was programmed when I originally studied accounting. So in our adjusting entry in these T accounts, we see that the prepaid insurance was the first one. It was debited. So I'm going to find that in my list. And there's our parent account prepaid expenses, and we see the one for insurance, it's $1,220. So that's going to be debited for $400. And now in our T account, we can see the other account insurance expense was credited for the same amount. So we find that in our list. And then this was specifically for the liability insurance. So I found the $5,012 liability insurance expense. I select that, and it auto-populated with the credit of $400. Now, a cool thing in QBO is that we can make these transactions, these adjusted entries, recurring if we want. Now, if we're going to make them recurring, I would probably remove the amount because it's not necessarily going to be the same amount every single time. It just depends on the timing of our insurance payment and how many months we bought. So the amount isn't there, but these accounts typically would be set up in the same order, like your if you're handling your prepayments in the way that this business did, the adjusting entry for insurance is always going to look like this, in that you're going to debit your prepaid insurance and credit your insurance expense. So what you could do is you could make the transaction recurring. You could give it a name. You could give it a name like adjusting entry for insurance. You could do it as a reminder so that the system would remind you maybe 3 days before you have to record it. You could set it up for monthly or yearly, depending on how often you're doing adjusting entries, and you can maybe set it for the end of the month, and you could tell the system when to start it. And basically QBO would prompt you, hey, you got to make your month-end adjusting entry for insurance each period. I'm not going to make it recurring today, but you can see that that's a capability and might automate and save you some time. So I'm going to cancel making recurring, but I am going to record the event. Now, it might be a good idea to include any attachments if you had them, like if you had the details on the insurance policy payment, and maybe in the memo you could show the calculation that we did. I'm not going to require that, but those are good practices. What I'm going to do for right now is I'm going to save and new, because I'm going to prepare another adjusting entry. So I clicked on this little drop down, save and new. And when I do that, you'll notice that the number for the adjusting entry changed from ADJ to ADJ2, and the date remained the same, which is going to save me a little bit of time. So now we're moving on to EM 9.2. We're doing an adjusting entry for supplies. If we look at the balances on our unadjusted trial balance, we do not see anything in here with respect to an asset account for supplies. The assets are in the 1,000 range. We don't see a supplies asset. But if we go down to the expense range, which is in the 5,000s, we do see this office expenses, which is, I believe, what they used for supplies. So we would have to, at the end of the period, ask, hey, did we use all of those supplies, or do we still have some? Because if we still have some, we should have an asset account reflecting what we still have, and then the expense account might be overstated because it should only reflect what was used. So on the screen over to the right, I've got a little reflection of that. So the supplies expense should reflect the supplies that were used this period. In this case, instead of calling it supplies expense, they called it office expense. And then the supplies asset account, which we don't have a balance in yet on this unadjusted trial balance, should reflect the supplies that we still have at the end of the period. So to get the expense account balance correct and the asset account balance correct, the business would have to take a physical inventory of the supplies that remain, and from that make the adjusting entry. So in the text in 9.2, it says that the business did exactly that, and they have $300 worth of unused supplies on hand. So now I'm going to make a T account to see this. So per the book, a physical count shows $300 of supplies remain. If we look at our T accounts, which we get the details from our unadjusted trial balance, we have this 5,024 office expense, aka supplies expense. It has a $1,439.50 balance, and the adjusted balance, since this is an expense account, should reflect the supplies that were used. Well, this $300, that's not what was used, that's what remains. So that's not the adjusted balance. And then over here on the other side, we've got the asset account supplies. That isn't listed, so it has a zero balance. And the adjusted balance of this asset account should reflect the supplies that we still have at the end of the period. Well, that's exactly what the $300 was. It was the supplies that remain. So the adjusted balance for our supplies account should be that $300. And then we have to think, oh, how do we get there? Well, we can see in this supplies asset that it has a zero balance. So to move from a balance of 0 to a balance of 300, we have to add 300 to the account. And the way that we do that with an asset account is by debiting it. So our adjusting entry will involve a debit to the asset account called supplies to add to its balance. Whereas the expense account has too much in it. That $1,439.50 hasn't all been used. So we need to subtract that unused portion, the $300 that remain. Well, to subtract from an expense account, you have to credit it. So that's what we're going to do with the other part of the adjusting entry, is we're going to reduce our expense by crediting it. And that will get our adjusted balance down to the correct amount of $1,139.50. And now we're going to do that in QBO through that journal entry. So once again, I pulled up the journal entry number 2 that appeared after I saved adjusting entry number 1. Make sure the date's still the 31st of January, and now I'm just going off these T accounts. And I'm following the convention of listing debits first. So the supplies asset account was debited for $300. So I need to find that in my list. And it is a sub account under this prepaid expenses, and I see it right here. 1,210 supplies is the account number, and that account had to be debited for $300. And then the other account that we have here is our 5,024 office expense. Since I know the account number, I can just type that in and find it quickly, and that had to be credited for the same amount. It still would probably be a good idea to write a little memo here and detail the calculation. All right, so then I'm going to select Save and New again because I'm going to prepare another adjusting entry next. But before I do that, I want to go back to my trial balance and show that if I refresh this page by hitting Run Report, I'm going to see the assets now showing up. So now I see that prepaid insurance asset showing at 300. I see that office expense showing at this adjusted balance that we determined earlier. Also, I didn't show it previously, but that insurance asset account is reflecting the unused portion, and the insurance expense account is reflecting the used portion. So going back to the journal entry screen and taking a look at our text. Now I'm working on EM 9.3. We're going to be doing an adjusting entry related to prepaid rent. And it says that Mookie, the Beagle concierge, had been renting a storage locker for inventory, and they had omitted recording the storage locker rental in QBO. So in other words, if I go back to the unadjusted trial balance, which is partially adjusted now, but it's not related to this storage locker situation, I guess we do have a rent expense, but apparently this is not related to what we're recording now. So it seems like this journal entry is going to be sort of a mix between a correcting entry as well as an adjusting entry, because they essentially omitted recording something that they should have recorded earlier, and we're also needing to adjust what would have been recorded earlier because now some of that rent has expired because time has passed. So it's sort of a adjusting entry slash correcting entry combo, really. But the detail here, let me read it. In anticipation of stocking the inventory, the business charged $1,800 for 6 months storage locker rental on the Visa credit card on January 1st of 2025. So that's the transaction they omitted recording. So at the end of the accounting period on January 31st, the business has used 1 month's worth of rent at $300 a month. And they showed that calculation by taking the $1,800 and dividing it by the 6 months. Then it goes on and says, so at the end of the accounting period, which we're preparing the adjusting entries at the end of January, on January 31st, the business has used 1 month's worth of rent, and as of January 31st, 5 months of rent is still unused. So if we paid a total of $1,800, we have to distribute that between what was used and what hasn't been used yet. So $300 a month, we calculated earlier, multiplied by 1 month gives us $300 of rent used, and then $300 per month times 5 months, because 5 months still are remaining. That works out to $1,500 of unused rent. So our adjusting slash correcting entry is going to reflect this. So I've set up T accounts for each of the 3 accounts that are going to be involved here. And we have the 5,028 rent and lease expense. We have the 1,230 prepaid rent. And then we have the 2,100 Visa credit card payable account. This is a liability account, so it increases on the right side. Prepaid rent's an asset account, so it increases on the left. And the rent and lease expense is an expense. It also increases on the left. So even though the rent and lease expense does have a balance in that unadjusted trial balance, it has nothing to do with this transaction in which we paid $1,800 for this rental locker. And so I'm not going to put that balance in this T account for visualization because it's an unrelated amount. What we see here from the calculations is that at the end of the period we determine that we've used $300 worth, so that's what should be placed into the expense account. So we're going to debit it for $300 there, and then the asset, the prepaid rent, should reflect the unused portion. We determine that to be $1,500, so we're going to place that on the debit side there to add to it. And then finally, the business never recorded that had paid for this rental locker, so the Visa credit card apparently was never charged for that amount, so we're going to place that $1,800 in there. So we are going to reflect what we did in these T accounts in the adjusting entry. You can see here the date again is always January 31st for this exercise, and the number of the adjusting entry automatically updated to adjusting entry number 3. And it doesn't matter which account I list first, as long as I'm going with my debits first, if I'm following that convention. So I'm going to say the 5,028. So if I know the account numbers, I can just type them in here. There it is. And that was a debit of $300. And then the 1,230 prepaid rent is our next account because it is also debited, so found that. And the system put it in the credit column because it wants to make journal entries balance, and most entries are often a simple entry with one debit, one credit, but nope, we wanted another debit, so I just click in the debit column there, type that amount, and that credit goes away. And then finally we have the 2,100 Visa credit card. So I can find that. Actually, it's on the screen right there, and the system sum those amounts. That's what I wanted to do, is credit it for 1,800. I'd probably put a little memo here for this one that, hey, we omitted recording this transaction earlier, so now we're making a correcting/adjusting entry here to get the payment properly distributed between the asset and the expense, and probably show these calculations in the note. And for right now, though, I'm going to hit Save and New and move on to our next adjusting entry. So the next adjusting entry relates to the concept of unearned revenue, and the narrative tells us that on January 21st, the customer Carlos Hafra prepaid for some pet services that were going to be provided over 8 weeks for the pet Bella. And it's telling us that we recorded the entire amount as sales. And if we look at our sales account here that would reflect the services, it is this 4,200 sales account. And because there's a lot of other sales in here, we don't see that 7,200. If we wanted to go research that amount and just verify that that is what happened, we can click on that amount. It'll pull up the ledger for that sales account only. And I'm going to maximize this just so it's a little easier to read, and we can see, sure enough, there is 7,200 received from Carlos Hafra here. So it does verify with the dates in the book and the details in the book. So then the text goes on and says, as of the end of the accounting period on January 31st, the day that we're doing all these adjusting entries, 3 weeks of these pet care services had been provided to Bella. So we need to make an adjusting entry accordingly. So with respect to this adjusting entry, we have 2 accounts. We have this unearned revenue account. That's a liability account. And the balance of this liability account should reflect the services that we still owe to the customer because that customer prepaid. Whereas the other account is our sales account, which is an income or revenue account. The balance of sales should reflect what we earned this period related to this transaction. And so mathematically, if we take the total amount that Carlos Hafra paid us of $7,200, divide it by the number of weeks of service that was supposed to cover, that works out to $900 per week. If we take that a little further, the text says that we provided 3 weeks of service, so 3 weeks multiplied by $900 per week gives us $2,700. That's the service we provided, so that's what we've earned. Whereas 5 weeks worth of service have not yet been provided. Multiply that by $900 per week. That gives us $4,500. Since that's not yet provided, that's what we still owe related to this transaction. So now we'll look at some T accounts. So per the textbook, the company originally handled the receipt of payment from Carlos Hefra as posting it to the 4,200 sales account as it had been earned, as if it had been earned. And then it did not use the 2,200 unearned revenue liability account. So with respect to this transaction, it has a balance of zero. Now the 4,200 sales, if we looked at the unadjusted balance of it, it's more than that because it includes other transactions. So I'm ignoring that balance and just focusing on how this transaction affected that account with this visualization through the T account. All right, so the math that we did earlier, we said that we provided 3 weeks worth of service and that's worth $2,700. Well, a revenue account, the 4,200 sales account, should reflect what we earned. So that's what the adjusted balance should be. Once we throw that into our T account, we can see that, oh, the account has an overstated balance currently. The balance right now is 7,200. I want the balance to be 2,700. So in my calculator, I take the difference between the two amounts and I see, oh, I need to subtract 4,500 from the sales account so that its balance reflects what was actually earned this period. And then the 2,200 unearned revenue account, that's a liability account, its balance should reflect what we still owe. And that 4,500 is the portion that we have not yet provided. That's the amount that we still owe. So that's what the balance of unearned revenue should be after adjusting. So looking at that T account, it has a zero balance right now. We want it to have a 4,500 balance, so we need to add to the account. And the way that we add to liability accounts is by crediting them. So there we have our adjusting entry. We are going to be debiting our 4,200 sales account and we are going to be crediting our 2,200 unearned revenue account. And now we just do that inside of QBO. So I'm going to list the debit account first, so it's 4,200 and then find it, and per the T account that was a debit of 4,500. And then our credit account was that unearned revenue as an account number of 2,200. Found it, and the credit is the same amount. So I can save in new. So the next adjusting entry relates to this 2,300 loans payable account. If you remember earlier in the class, the owner of the business made a loan to the business, and there was supposed to be interest that was being charged. And per the textbook in section EM 9.5, it says interest has been charged, but it has not been recorded or paid yet. So the way that we calculate interest is by using this formula. We take the principal of the loan, multiply it by the interest rate, multiply it by time, where time is going to reflect the interest rate that was used. And since the rate was an annual rate, time would be the number of years or the fraction of a year. In this case, since we're talking about a 1 month period of time and there's 12 months in a year, we're going to use the fraction 1 out of 12 months. So we do that calculation and it works out to $10 of interest that we've been charged but we have not paid. This is going to be an example of an accrued expense, so we're going to record an expense before we pay for it. So I've set up T account for the two accounts that are going to be impacted by this information. We've got our interest expense account and then we've got our interest payable account. And over in the adjusting entry here, I'm going to type in the word interest, and there I see the interest expense account. And if I type it again, should be able to, nope, I don't have an interest payable account. So per the textbook, we have to create one. So we're going to backspace there, create, add new, and then type in the name of the account there. And then the account number per the book is 2010. And the account type is going to be a current liability and other current liability. And for the detail type, we're going to select other current liabilities. So then I can save that account to the system, and now I can make the rest of my entry here. So we are going to be adding $10 to our interest payable account, and since that's a liability account, we increase it on its right side.
And then we're also going to be adding to the balance of our interest expense account. And since that's an expense account, it increases on its left side. So then we just do that inside of QBO. And then once we got those debits and credits in there in the right spots, we can move on to our next transaction. So we click on the Save and New button.
In our next adjusting entry, EM 9.6, it says that one of our contractors, Evan Henry, provided pet care services to Carlos Hafra's Bella for 3 Fridays in January, totaling 24 hours at $40 per hour. We overlooked recording this expense because Evan had not been paid for these services yet, so at the end of the month, an adjusting entry is needed to show that we're going to be paying this expense later. This is an example of an accrued expense because we're recording the expense before it is
paid. So if we do the math there, we've got 24 hours multiplied by $40 per hour, which gives us $960 of unpaid expense. This is an expense to our business because we have used Evan's services, but we also haven't paid Evan yet, so we need to recognize that as well. So we're going to record that as a increase in our accounts payable liability because we still owe it. So our liability account payable, since it's increasing, we're going to place that on its right side. And then since our contractor's expense is also increasing, that's going to go on its left side. So then we just need to reflect that in QBO. And when we make the credit to accounts payable, or anytime we use accounts payable in a journal entry, we also need to specify the name associated with it. And this is for our contractor, Evan Henry, so we should be able to find their name here, and sure enough. And now we can move on to our next transaction, so we're going to click Save and New.
So moving on to EM 9.7, it says that at January 31st, the company has incurred $660 worth of accounting services for assistance with QBO. So you were doing all this work all the time and you thought you weren't getting paid, but you are. Remember that you're a contractor in the system. It says that the amount has not been paid nor recorded by the company, so an adjusting entry is needed. So if you visualize the T accounts here, it's telling us the value of the services was $660, so that needs to be added to the 5022 legal and professional services expense account. That's an expense account, so it increases on the debit side. And then the business has not paid this amount out yet, so it's incurred a liability, so we need to add to our liability. We do that on the credit side using accounts payable for that. So now we'll reflect that in the journal entry here. So the 5022 account is being debited, so I'll list that out first. Found it. The amount $660. And then the accounts payable is listed next, and there it is, same amount. Now because we're using accounts payable again, we have to give it a name, and it says that it was you did the accounting work. Now you're in the system as a customer. Don't select that one. You're also in as a vendor, and if you followed the video earlier in the instruction in the book, you probably use something like first initial last name. So I see myself there, but find yourself in the system and select that for the name related to the account payable. And I think we have one more adjusting entry after this, so I'm going to select Save and New. Okay, so we have one more adjusting entry, and essentially it says that the owner of the business forgot to record a transaction in which they purchased some renter insurance coverage for the storage locker property, and they used the Mookie the Beagle credit card for that, the Visa credit card for it. So we just need to record it. It says that by the end of the period, all of it had expired and the amount paid was $36. So I've set up the T accounts here, and we can see that this isn't really an adjusting entry. This is more of a correcting entry because they omitted something, and the omission didn't have a follow-up adjustment, so I don't really see this as an adjusting entry at all, but we still need to record it. So whether we call it an adjusting entry or a correcting entry doesn't really matter. So what we're going to do here, it says that we're were incurred $36 of insurance. So we're going to add to the insurance expense, and then it was a charge on the credit card, so we're adding to the balance of the liability by placing it on the credit side. So that's what we're going to see in the journal. Since we're going to list the debit first, I'm going to put in the 5011 in the first line, find that renter insurance expense, debit it for $36. And on the second line, it's going to be the Visa credit card, which is an account number of 2100. Found that, credit it for the same amount. Probably put a little note here, and if we had that receipt, we'd attach it. But that's it. So now I'm going to save and close out of the journal entries. So now if I go back to my reports and pull up my standard report and my trial balance, so I can just type that up top here.